when at the April lows, we thought we could make a move back to 5,500.
Right, we're at 5,900 on the S&P.
That's right. But our full year target was 6,600. So I think that's still a reasonable expectation.
You never changed that?
No, it felt very shaky because that would have been, a couple 1,000-point move needed. But now that I look at 2026, I think businesses are in better shape now than they were in February. So I think making 6,600 actually seems more achievable today than it did. I think that the waterfall decline into the April lows was such a reset of sentiment. People talked about Armageddon, and we saw some of the most rapid deleveraging of hedge funds ever, and a collapse in investor sentiment, and a huge change in positioning. So those are, I think, things that look like what happens in a bear market. And the ISM has never broken above 50 in a sustained way. Market tops usually need an ISM to stay above 50 for a period of time. So I think we're at the start of a bull market. And as I look at 2026, I think housing could actually be a big lever to pull next year. Well, as you know, the inflation for the last month actually has defied expectations because a lot of people said these shortages would cause a spike, and instead core inflation actually has been trending lower. To me, inflation was really a story about housing and auto insurance. Those were powering inflation for the last 2 years. Combined, that's 75% of the rise in inflation. Housing is actually now subtracting from inflation month over month. And I think in some ways, on a real-time basis, that tells me I don't think core inflation is actually going to be turning up, even if goods prices go up. Well, I think that if core inflation behaves, then we are in a really tight real rate environment, right? 4.5% monetary policy and 2.5% or 2% core inflation. There's a need to actually reduce interest rates. The U.S. is on an unsustainable sort of path for deficits, but Japan's actually had higher rates, and their interest rates have been behaving for a long time. Not recently. So I think the long end is essentially unpredictable. When investors worry about it rising too dramatically, then I think that's when the bond market can have some influence on both the Fed and the Treasury, but I think at these levels, it's not that alarming. I think it's consolidating. It makes sense. Bitcoin is responding to global liquidity, which is moving up, and I think anticipating a dovish Fed next year, so that's a tailwind for Bitcoin. But, Bitwise has a great stat. 95% of all Bitcoin's been mined, but 95% of the world doesn't own Bitcoin. So I just think that there's still a huge demand versus supply imbalance, meaning there's a lot more potential buyers of Bitcoin over the next 10 years. And so I think there's a lot of upside into year end. 150, maybe 200, even 250 this year.
What?
Well, it's, I think at a minimum, it should have the same network value as gold. Mm-hmm. And if you look at above ground gold, it's probably 23 trillion. So that would be, 1.2 million for Bitcoin. But I think Bitcoin is more valuable than gold. So, Bitcoin could be 2 million, 3 million long term. Even higher. When we go back to February, when the market was at all-time highs, we have to keep in mind we had a lot of uncertainties ahead of us, and we weren't necessarily looking at 2026. The tariff visibility is much better today than it was 3 months ago. And when we look at 2026, I think that there are things to look forward to, such as deregulation, tax cuts, probably doing more cuts now in 2026. And then from a company perspective, companies survived, I think, a black swan event. That waterfall decline in equities and the sort of the near heart attack of the economy still was an environment where companies produced earnings that beat expectations. So this is the fifth stress test for businesses. When I put all that together, I think PE's probably going to be higher in 6 months than lower. And when you think about 2026 earnings having upside, I think there's still upside for stocks. That waterfall decline in stocks also was almost a complete reset in positioning and sentiment. Investors were forced to liquidate when the VIX hit 60. We know a lot of institutions didn't add risk back as the market rallied. So I think the pullbacks are going to be pretty shallow because investors just are underinvested at the moment. And then when you look at sentiment, it's barely turning neutral now. So if investors have been fighting this rally, as they become more neutral or more optimistic, that's upside for stocks. We are now in a new world of tariffs, and businesses are adjusting. I think one of the things that we're seeing is that the market is now in a position where they can start to look through some of the messy adjustments, right? We know there's been a disruption to the supply chain. I think stocks can look through that. But you're right, Scott, there is now this world where there's essentially a consumption tax in place on things that we're importing. But that doesn't mean we have to actually have the PE decline or the markets to fall. It's now just something we have to kind of manage through. Well, I think Fed Chair Powell made a good point that long-term yields could be rising because of inflation volatility rather than inflation expectations going up. That's actually an opportunity for markets because if inflation volatility delivered is less than expected, then we could expect yields to come down in the future. Yeah, Scott, there was a moment like that a few years ago when an auction went badly and many people declared this was sort of the end of the ability for the US government to finance, and people panicked and the VIX surged. Even in that moment, it proved to be a buying opportunity for equities. So I think if there is a moment where maybe the bond market sort of has a tantrum about that, and I'm not saying it's going to happen, but if it does, I think we have to remember the U.S. is a huge economy. There is still a lot of trust in the U.S. And I think those who've called for the end of U.S. exceptionalism, I think that's been the premature call. And if none of those is true, the bond market and investors can handle even a 4.5, 4.7% 10-year.